This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Remember the famous quote, "The stock market is never obvious. It's designed to fool most of the people, most of the time." You can say the same thing about the bond market. Consensus coming into this year was that stocks would take a step back and bonds would have their day. Neither has happened so far. So in light of a hotter than expected economy and inflation, where are we left now? Stay tuned. Welcome on board another edition of our Wise Investor Group podcast. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. Happy to be with you. A newsworthy week for sure. We've started to see an uptick in volatility for the first time all year, and not hard to guess why. Interest rates and inflation seem to be the thing that get people irritated, hot and bothered more than anything else. Just literally 3 or 4 months ago, Wall Street, some of the big Wall Street firms were thinking we're going to get maybe as much as 7 or 8 Fed rate cuts this year. 7 or 8. This is just back in December and January. Now Wall Street consensus is down to 1 or 2, and you've even heard some people talking about potential rate hikes, which is kind of hard to believe. So we've had a complete about-face in the consensus thinking, and that was kind of reinforced this week when we got the inflation data for March, the CPI, the Consumer Price Index, which showed a little bit of acceleration, up to 3.5% on an annualized basis. That was about 1/10 of a percentage point hotter than analysts' expectations. Quite frankly, I don't think it was as bad as maybe some made it out to be. I mean, a lot of it came from an increase in auto insurance premiums, some medical costs. It wasn't as pervasive and widespread as maybe the headlines would suggest. I would also say that a lot of the slowdown in rental prices, which is a big part of the CPI, has not been reflected in the data yet. That's probably coming over the next 6 months. So I don't think it was as bad as maybe it was suggested, but certainly the Dow went down over 500 points, and we saw a significant sell-off in bonds. The 10-year Treasury yield back up to roughly 4.55%. And so we're going to talk about that. We'll talk about what that means. This morning, I would also just kind of as a sidebar, just observe how narratives change. Right? It's a good reminder not to buy too much into what all the headlines are saying. Because what have the headlines been saying, for months now, for 6 months? That the two big themes, the only reason stocks are up is because the quote-unquote Magnificent Seven is doing well and that the Fed's going to cut rates. Well, like I said, neither of those things have really been as much a theme recently as the headlines would have you believe. The Magnificent Seven has definitely slowed down. Yes, there are still some strong performers within that group, but a couple of the big names like Tesla, Apple have negative returns so far this year, and you're not seeing as much money flow in that direction as you were a few months ago. And of course, as I just mentioned, the prospect for rate cuts has been diminishing literally by the day. As we've gotten new data. So those really aren't the narratives that are driving the market, yet here we are. S&P was up over 10% in the first quarter. So the stock market's apparently going up for other reasons. And I think the big reason, and again, we'll talk about this in a couple minutes, is the fact that earnings have been better than expected. For the first time in a long time, earnings estimates have actually been going up, right? That's the flip side of all this. If people are worried that the economy is too hot, that we're creating too many jobs, that inflation is a little hotter than expected, well, that also means that corporate earnings are probably going to be better than expected. That might be kind of the silent narrative, if you will, that's not getting as much attention that we're going to be laser focused on, particularly here in the next few weeks as we get the first quarter earnings reports. And so, again, we're going to talk about all these things, but I thought it was worth mentioning that be very careful about locking into just what the headlines are telling you about what's driving the market. Chances are there's something else happening, or that stock prices are already looking forward to a narrative, to some other story that hasn't yet been reported. And that's what we try to do as wise and quote-unquote wise investors, is keep you abreast of that, keep you in tune with what the market might be paying attention to down the road. But just a couple quick thoughts on the first quarter. It was a great first quarter for the indexes as a whole, the stock indexes. The S&P, by my count, going back all the way to the late 60s, early 70s, I think had its 11th best first quarter, up 10.2% in the first quarter. And I think the key message here, and I've been making this point in recent shows, I think Chase Hinderstein has as well, that we shouldn't fear momentum. What goes up does not necessarily has to come down. Generally speaking, when we get this type of positive upside momentum, it begets future gains. That's the trend. Strategas, the economic and market research think tank, they made the key point. They looked at the best 15 first quarters in the last 50 plus years, right? And as I mentioned, this was the 11th best. They found that the average kind of pullback in the second quarter was modest. So the idea that we have to give it all back with a sharp correction is not borne out statistically or historically. The average gain in the second quarter over all those 15 periods was 3.4%. Yeah, there were a few incidences where the market did not do well in the second quarter, but they were minor. The worst was a 3.3% loss, and that was in 2012. And then if you look at the rest of the year, so if you look at March 31st through December 31st in all these 15-year periods, the average gain was another 7.4%. The only time where it wasn't positive was 1987. You had the 1987 stock crash. And by the way, you still had a positive return that year for the market, just not in the last 9 months of that year. They also note that when the S&P gains 10% in the first quarter or more, and this is basically just a repeat of what I just said, but said it a slightly different way, we finished in the green in all 11 instances with a median gain of 23% for the calendar year. I'll give you one more factoid sending a similar message. S&P, give or take, is up about 25% in the 5 months since the October low. According to Strategas, if you look at all the 5-month periods going back to 1970, where the S&P was up 25% or more, it's 130 times, there was only one out of 130 with a negative return 12 months later. So, as you well know, past performance is no guarantee of future performance or future success. Anything can happen over the next 12 months, but the historical record and the statistical record show that we shouldn't fear a good rally. Let's put it that way, okay? But I would also say that, and I said this 2 weeks ago, we cannot at all rule out the potential for the market to pull back in the short term. Okay, as I mentioned, we haven't really had a pullback of any consequence since the summer, right? I mean, so from July through early October, market went down almost exactly 10%. And so it's been a while. It's been a while that we've had a pullback. And we're definitely starting to see some flagging signs of market momentum, not only at the overall S&P 500 level, but with technology and with technology specifically. I mean, if you look at short-term momentum indicators like the 50-day moving average, tech has broken below that. So we're definitely seeing some steam coming out of the balloon. You've also seen consumer sentiment and investor sentiment figures pretty frothy. I mean, if you look at the Investors Intelligence Survey as of a week ago, the number of bulls in their survey was up to 62.5%. That's the highest since April of 2021, so highest in 3 years. And remember, investor sentiment is generally a contrarian indicator. Generally, when people are too fat and happy, too bullish, it's often when we get a pullback. When people are extremely negative, it's often when we get a bounce. Doesn't always work like that. You can't, swear on those indicators, but tends to be accurate more than not. So the combination of the fact that we haven't had much of a pullback in a number of months, that investor sentiment is maybe a little too comfortable. Also in the first quarter, according to FactSet, we had the least volatility since 2017. In fact, if the year ended today, we would have had the smallest drawdown in the first quarter. I think the S&P only pulled back a maximum of 1.7%. That'd be the smallest of any year in U.S. history. But I won't belabor the point. These things all suggest that maybe we're due for a little bit of a come up in the short term. And maybe that's what this week was, right? Maybe it wasn't so much that the inflation figure was too hot. It was just that the market was kind of priced for perfection. So to get a 500-point down day and just general sloppiness over the last few weeks, no surprise whatsoever. I mean, JP Morgan noted this week that in the last 45 years, the average annual drawdown was 14%. That's the average. And the market finished positively 33 out of those 44 years. So the market's basically gone up in the last 44 years, 75% of the years, 3/4 of the years, with an average of a double-digit pullback every year. Worth noting. One other thing I just wanted to mention, I saw a really interesting study from Piper Sandler. They looked at the last 27 corrections of 10% or more, and I think they went back to 1964. Okay, so 27 corrections of 10% or more going back to 1964. And what they argue is very interesting, that every single one of those 27 had at least one of three main catalysts. 1, higher interest rates. 2, rising unemployment. 3, a global, some sort of exogenous issue like a 9/11 or a terrorist attack, something like that. Okay, every correction had at least one of those three. And if you look at the recent environment, certainly the pullback we had in July, I think you can make a strong argument that that was due to a spike in rates. 10-year Treasury went up to 5%. Of course, 2022, also, I would argue, mostly due to higher rates. The Fed took rates from 0 to 5%. We all know about COVID, which was essentially a job loss, an unemployment spike. That was the main reason for that pullback. Okay? And obviously, I can go back further. And what they noted was employment-related corrections are generally, with the exception of COVID, that was sort of a one-off, but most of the time when you have a significant hit to employment, those are the longest duration corrections, and most often fall into the classic definition of a bear market, 20% or more loss, most of the time associated with recession. In contrast, Piper points out that market corrections that are attributable to higher interest rates, far more common, with much less severe declines over much shorter periods of time. They say that essentially all the downturns in the 60s, 70s, and 80s were the result of interest rate spikes. Lastly, market corrections resulting from global issues tend to be the most short in duration. They can be as much as a 15% drawdown on average, but don't have a long shelf life. So, I don't know if there's anything to really take away from this from sort of a portfolio positioning standpoint, but I find it very interesting that if this in fact is the first week or 2 or 3 of sort of an interest rate scare, I don't think this is a correction that we necessarily need to sell into. It could be a relatively short sort of repricing of risk, repricing of the markets, repricing of asset prices, repricing of valuations for a different type of interest rate outlook than maybe what was expected 3 or 4 months ago. My feeling is it would be fairly short in duration, probably fairly short or low in terms of depth, and maybe something that would be an opportunity for investors who are appropriate for taking on stock risk. So anyway, just a few thoughts there. Just a couple other things that I kind of wanted to get into. Of course, as I mentioned, we're right on the doorstep of earnings reporting season. We'll have a lot more to share with you on what we're hearing from some of our top holdings in the coming weeks. But I think what's interesting is underneath the surface, I mentioned a few minutes ago how the Magnificent Seven as a group, obviously there are a couple that are still stellar performers, but as a group, has certainly lost a little bit of steam. What you may not know is that in equal weighted terms, energy, industrials, financials, and materials, those 4 sectors, actually all outperformed technology in the first quarter. I think that doesn't get very well reported. Energy specifically hit a 4-month relative high relative to the S&P 500. Utilities, believe it or not, they have started to show some life after essentially 2 years of being pretty much the worst sector to own. Financials in an uptrend. But what's also interested in is that the average investor does not appear to be getting the message, right? If you look at recent asset flows, so if you look at 200 asset flows over the last 250 days, this is data according to FactSet, you've actually seen outflows from funds, exchange-traded funds and mutual funds that own healthcare, staples, energy, utilities, materials, financials. All of those have shown outflows over the last 250 days. And remember, 3 out of 4 of those were the best place to be in the first quarter. And we're seeing green shoots in utilities, and healthcare has been decent too. So here you have an example of unloved sectors, I think that's fair to say, starting to get some traction. Overall, if you look at the market from sort of the index down, earnings, according to FactSet, are expected to be up about 5% this quarter. I think what's really significant, and I mentioned this at the top, for the first time in some time, earnings estimates have actually been going up as we move through the year. It's very rare. Usually analysts start out optimistic and sort of temper their expectations over time. This has been the opposite. That has to be considered bullish. In fact, even going out to 2025, in 2025, analysts are expecting 13% year-over-year growth. So as I mentioned earlier, this is the flip side of all this fear about, potential higher interest rates, potential higher inflation. That probably means, no guarantee, but probably means higher corporate earnings. And when you have a strong job market, it obviously supports consumer spending and better corporate outlooks. So earnings, in my opinion, remain sort of the underreported bullish story, kind of keeping this market afloat. And you're certainly seeing it, with economic data. I mean, I was looking at the Federal Reserve Bank of Philadelphia's state coincident indicators. So what that means is those are kind of real-time measures of economic output across the state and across the country in all 50 states. Well, what I saw in January, I haven't seen the recent data, but what I saw in January is the 3-month average of the indexes increased in 49 out of 50 states. 49 out of 50. Actually, I did see the February data, excuse me. The February data, the 3-month average increased in 43 states. Only decreased in 3 out of 50, was stable in 4. So the expectations of a recession continue to be belied by strong growth in the majority of states, strong hiring. We saw 300,000 jobs created last month, wage gains, and consumer spending. So again, that's kind of the flip side of this let's worry about higher rates narrative. And you're seeing a lot of other data too. I read the CFO, Chief Financial Officer Optimism Index. That's something I followed for a long time because those are the guys that tend to control the purse strings at companies, right? The CFO Optimism Index just ticked higher in the first quarter survey. First time that's happened in some time. And what's even more encouraging is the improvement that they're seeing in the U.S. economy. So they're recognizing it. I think that is another bullish sign for earnings. And what's also interesting is when asked to describe the motivation for investing in AI and other technologies, which you've started to see an uptick in, obviously, spending on IT infrastructure, it's to save money. So here you have companies stimulating the economy by investing with an ultimate goal of cutting costs. And so this idea that, profit margins inevitably have to come down in the face of higher interest rates, I don't know if that's going to be the case. I mean, they may not explode higher, but I think there's a pretty good underpinning for profit margins and therefore earnings. And by the way, if you're questioning or wondering about the correlation between earnings and stocks, over long periods of time, it's very tight. I mean, if you look at earnings charts for the index versus stock performance for the index, they tend to move in locksteps. Yes, sometimes one kind of front runs the other. Weakness, comes before strength in either direction. But there's definitely a long-term correlation. But there's also been a correlation recently. I mean, if you look at the Magnificent Seven, which remember is Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla, right? If you look at that group that's gotten so much attention, and you look at the fact, how well that those stocks did collectively last year, well, it was backed by earnings growth. I mean, the fourth quarter last year, according to FactSet, 60% earnings growth for that group. Third quarter, about 55% earnings growth. Second quarter last year, 40% earnings growth. When they were getting killed in 2022, remember, the Mag 7 did very poorly as a group in 22. Fourth quarter of 22, negative 30%. The reason this is important is because if you look at forward-looking estimates, and again, this is according to FactSet, you are seeing a much more conservative outlook from the analyst community. Consensus estimates, for example, the back half of this year, third quarter of this year, calling for only about 9 or 10% earnings growth from that group. Fourth quarter, about 23, 24%. Still pretty good, but certainly much lower than what we experienced last year. And the other important thing is if you look at aggregate estimates for the rest of the market, including some of the international markets, they're actually either at the same level or even higher in some cases than what's expected from the Magnificent Seven. So this idea that we've had some broadening, remember, I just mentioned that some of these other sectors, energy, financials, materials, industrials, healthcare, even a little bit of utilities, the fact that some of these other sectors are starting to do better on an absolute and a relative basis is not an accident. I think it's reflective of the fact that their earnings over the next 2, 3, 4 quarters are expected to be much more competitive with what we've seen from the mega tech stocks. And some of that's supported by the economic data too. If you look at the Purchasing Managers Index, rose to a little over 50 in March. Remember, over 50 reflects expansion, under 50 reflects contraction. There's been a very tight relationship between the Purchasing Managers Index and earnings. And so the fact that that's reflecting expansion, I think, is correlating with the fact that analysts are taking up their estimates. So, I'm not trying to make the point that we're wildly bullish on the markets at this point, but I am, I think, making the point that some of this broadening that we're seeing in the market could easily continue, and maybe for a number of quarters to come. So this is why we've argued so much in the past year for portfolio balance. Yeah, if you want to own some of the AI-related names, semiconductor names, I totally appreciate that. That has obviously made a ton of sense in the last year. But if you've given up on some of these other sectors because maybe they underperformed last year relative to the S&P, I'm not going to go so far as to say you've made a mistake, but looking forward, you may want to rethink that, okay? And again, valuations send the same message. The S&P 500 as a whole is the most expensive it's been in a number of years, probably at least 30% pricier than the 15-year historical average, according to FactSet. But if you back out the Mag 7, not cheap, but it's probably more like 17, 18 times earnings. Not completely unreasonable. So keep that in mind, and that's why you're gonna hear me continue to talk about keeping portfolio balance. I think it's very, very important. The last thing I just wanted to comment on, when I was on a couple weeks ago, I talked about bonds. The bond market continues to struggle. We are definitely in the longest bond drawdown, the longest and deepest bond bear market in 150 years. I mean, we're up to, I think, 45 months now. So almost 4 years of a bond bear market. And it hasn't gotten any better recently. I think the Barclays Aggregate Credit Index, which is sort of the index that most people follow for bonds, I believe is down somewhere in the neighborhood of 2.5%. Don't quote me on that, but somewhere in that range year to date. Okay, so it's been a very frustrating time for bond investors. And according to Strategas, for the first time ever in their math, the long-term treasuries have been negative since the Fed pause. Usually long-term treasuries start to rally when the Fed pauses. So clearly the bond market believes that we're not quite out of the woods yet. So I realize it's been a tough market for bond investors, but I would just say a couple things. I still think that Obviously, cash is and cash-related, cash-equivalent assets like money markets are obviously very attractive. I mean, you can get roughly 5%, give or take, in Treasury money markets, other types of money markets at this point. And that's obviously very attractive with interest rates going up and prices going down. But just remember this, and I'm not going to really offer any guidance there because I know the decision on how much cash to hold is very nuanced depending on each individual investor and his or her goals and objectives. So I'm not going to get too much into the merits of cash or not being in cash. But I will say this, that a lot of people equate the idea of keeping money short-term in cash with being conservative. But in reality, staying short is not necessarily conservative at all. It's really just a call on interest rates. You are making the call that interest rates are either going to stay the same or go higher. Okay, that's the call that you're making, which, quite frankly, is a call in many of our portfolios that we're not willing to make, which is one of the reasons why we realize we may be early, but we're okay starting to go out in portfolios where it's appropriate. I'm not giving blanket advice here. It depends on the client. But where appropriate, we're starting to ladder out maturities. We're starting to go out 3, 5, 7, 10. I think the furthest we're going out is 13 or 14 years because we want to lock in some of this yield. The best yields we're seeing in some cases in 20 years for the foreseeable future. Okay? So you have to determine why you have the cash that you have. Is it needed for a particular purchase, spending initiative? Is it so you can sleep at night? Something to be said for that as well. Are you drawing heavily from the portfolio and you just want to keep a safety net? All those things are legitimate reasons to have a lot of cash. But if it's simply because you think rates might go higher, you may want to think about a different type of strategy going forward. Last thing I'll say on that front, I mentioned this 2 weeks ago, that some of the big investment houses put out asset class kind of projections based on valuations, whatever other metrics they consider, what they think various asset classes will yield on an annualized basis over the coming decade. And I saw one the other day that was updated, okay? I gave some data from the beginning of the year. It was updated just for a few weeks ago. This major investment house that controls trillions of dollars in assets, literally, they think that U.S. equities will be somewhere in the 3.7 to 5.7 annualized return rate over the next decade. Growth stocks specifically, 0.9 to 2.9. Meanwhile, they think in aggregate, U.S. aggregate bonds, which includes treasuries but also investment-grade corporates, 3.9 to 4.9. So they're essentially saying, and I'm not saying that they're right. I have no idea if they're going to be right or wrong. But I think it's very interesting that one of the largest asset management firms in the world, maybe the largest asset management firm in the world, thinks over the next 10 years that bonds will essentially deliver the same return as U.S. equities, at least at the index level. By the way, with about a third less volatility. So this was not meant to be a pitch for bonds, but I think with this additional spike that we're seeing in rates here just in the last few weeks, forward-looking returns for bonds could potentially be a lot more competitive with stocks than they had been in a number of years. So I think that the real lesson is you can't invest by looking in the rearview mirror. You got to look at what could be expected or is likely to be expected going forward. Keep that in mind. Up next, stick with me. I don't have a lot to say on the individual stock front because we're just about to get corporate earnings, and I'll have a lot more on kind of specifics for you, if you will, in the coming weeks. But I did want to highlight a few things. Stick with me. Back in a minute.
Will the Magnificent Seven continue their spectacular run? Be careful relying too much on last year's playbook. Tune in every week to hear Simon Hamilton and Chase Henderstein discuss the latest financial trends and what investors need to know. To learn more about some of the most important planning topics to consider and how to become a better informed, wise investor, listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the Wise Investor Show. I just had a few thoughts on energy, kind of at the sector level. Don't have any specific energy ideas, but just a few thoughts. I had mentioned earlier that energy relative to the S&P is seeing some of its best performance in a long time. Energy stocks as a group, and again, I know there are individual stock situations that may differ, but as a group, as a sector, has been an underperforming sector the last 2 years, after being a very hot sector in 2021 and 2022. So it has not been a good place to have your money. But that has really started to change, both on an absolute and a relative basis. And I also think that, the bar for energy is very low. I mean, if you look at earnings forecasts for this quarter, for example, for the first quarter, analysts are calling for energy to have essentially the worst performing earnings in the first quarter, worst performing. Yet, the stock prices are starting to move. So it tells me the market believes that those might be conservative estimates and that a number of these companies might beat to the upside. I also mentioned a few minutes ago that it's an unloved sector. You have seen net withdrawals in terms of, if you look at cash flows in and out of mutual funds and exchange-traded funds, energy sector has seen net withdrawals over the last 250 days. Meanwhile, energy prices, oil prices specifically, whether you're looking at U.S. oil or global oil, have been going up. And the economic backdrop for oil is, I think, a lot better than people realize. One, of course, and the obvious, is that recession risks have seemed to be ebbing. Doesn't mean that they're off the table. We could still get a slowdown at some point. But the global economy is outperforming expectations. That bodes well for energy. Remember, OPEC is still cutting significantly while non-OPEC supply growth appears to be tapering off. So you have pretty firm demand in the face of resilient supply. There's also a lot of geopolitical risk that's getting priced into the markets, not just the conflicts in the Middle East. I mean, if you see any sort of expansion there, God forbid, involving Iran, I have to believe that would be a tailwind for oil prices. And then there's the newfound development of Ukrainian drone strikes on Russian refining facilities, if that starts to get more traction. So there's certainly a supply-demand scenario and a geopolitical scenario that bodes well for oil prices. I will also say, and this is according to Strategas, that free cash flow across the sector has been inflecting positively. Obviously, a lot of that is a result of higher prices, but I think the key point that they're making is that the stock prices tend to correlate more with a change in trajectory, an inflection in free cash flow, and as I mentioned, they're inflecting positively, more so than absolute levels. So even if earnings and cash flows are just starting to turn positive, you may see the sector and the stock prices start to rally, ahead of any major changes in free cash flow. And just in general, according to Strategas, the balance sheet strength of the energy sector is probably better than it has been. Something like 65% of the debt among the companies that they measured matures beyond 2030. So you don't have a lot of refinancing risk. So in a general sense, I realize energy is not for everybody, particularly fossil fuel stocks. We certainly have a number of clients that have no interest in owning fossil fuel companies, and I totally respect that. You have to make your own decision there. But it would be irresponsible of me not to comment on a sector that could be about to do a lot better than it has in recent times. Just my general disclaimer, as I always mention, I do have a few individual stock updates for you. Remember, that if you're a client of ours, I think you can feel pretty confident that we've done our due diligence, and if you own it, that we feel that it's right and suitable for your portfolio. If you're not a client, can't manage through the computer, you've really got to do your own homework. Make sure it's right for your particular situation. The names that I mentioned, we own for a number of clients. I also own in my personal accounts, which represents a conflict of interest. So you need to weigh that for yourself. So just a couple updates. Constellation Brands, symbol STZ. They're kind of an off-cycle reporter, so they actually just reported earnings this week, fourth quarter earnings. Remember, they are the largest wine and beer importer in the U.S. The real driving force behind the company is Mexican beer imports. So Modelo, Corona, Dos Equis, which we have suggested for the last few years is far and away the most dynamically improving category within beer. And that continues to be the case. I mean, if you look at any sort of study of beer preferences in this country, not necessarily the highest sales, but what beers people actually prefer to drink, they're dominated by Mexican beers across all demographics, millennials, Gen X, baby boomers, you name it. And we've seen that's been the fastest growing category within that space. There was some concern that Constellation's business could be slowing on the beer side because remember all that Bud Light stuff last year where people were boycotting Bud Light and that shifted some demand to other Mexican beer companies, Canadian beer companies, European beer companies. And the fear was that relative to that quarter, that would be hard to show a lot of growth. Well, Constellation, we saw no signs of that. They were able to keep up almost 9% year-over-year revenue growth on the beer side. So very impressive results there. On the wine side, remember what they've been doing is they don't really care about volumes at this point because they've been divesting a lot of their low-margin wines, shrinking actually their sales, deliberately shrinking their sales of low-margin wines, and instead focusing on the premium brands. So yeah, we saw some revenue shrinkage. However, their margins actually improved, which is spot on with their strategy. So Constellation looks to be continuing to do well. Their valuation is not particularly demanding. They raised their estimates for the next year. They're trading now at less than 20 times earnings, which if you compare them to the consumer staples sector broadly, the beverage group more narrowly, they stack up very well relative to their competition. I think in terms of the risk factor, they're focusing on premium brands, premium wine brands, in some cases premium beer brands. So I think there's certainly the risk that if we do get further ebbing in consumer demand or if we, God forbid, get a recession, you see people tend to trade down to lower price, beers and wine for that matter. So that could adversely affect them in a less rosy economic scenario or certainly a less rosy unemployment scenario or employment scenario. So that's probably the biggest risk factor, but in terms of their execution, I think they're worth looking at here at less than 20 times earnings. Costco did not report their earnings, symbol COST, but they did report their March results. And they're worth noting because they continued to be impressive. They showed global sales, not just in the U.S., global sales of 7% growth year over year, 7%. And this is coming at a time, remember, when the consumer is starting to show some cracks. I mean, if you look at some of the reports from other retail companies, like some of the cosmetics companies, for example, some of the retailers, they're definitely noting the consumer pulling back. So this tells me that Costco's picking up market share. It's not like they have a bunch of customers that have different wallet sizes than these other companies. It's that they are picking up market shares, particularly if you look at where their growth is coming from. It didn't come from groceries, staples, people going in and buying, milk and eggs. It came from non-groceries, durable goods. Okay, so that, again, in my mind, and I haven't had time to listen to their conference call yet, but in my mind, that tells me they're picking up some market share. And I think it also speaks to the loyalty of the brand, the membership. We've talked before about how Costco has not raised the fee on their annual membership. That's a lever they can still pull if they want to. So they decide at some point they want to raise that by 5 or 10%. They have tried not to do that because they didn't want to add more cost to the consumer. But that is a lever they can pull if they want to. The risk to Costco is the valuation. We've talked about this. The market has rewarded their execution. I mean, they're trading at their most expensive valuation at like 45 times earnings that they have in a number of years. So there's just not a lot of margin for error there. And I wouldn't be surprised if their upside was somewhat, I don't want to say capped, but if their upside moderated in the short term just because the valuation makes it hard for them to grow. But given their execution, in my mind, it's the type of stock where if we were to have a market pullback or even an economic pullback, they could be interesting. So Costco and Constellation Brands, two to probably keep your eye on. The only other one I just wanted to mention briefly is UPS, symbol UPS. My colleague Chase Hinderstein talked about them at length a few weeks ago. Remember, they're really focusing on the bottom line execution. Like a lot of the big, transport and delivery companies, they got bloated during COVID, right? They had to add labor, they had to add procurement facilities, distribution facilities, buy more planes, because we were all sitting on our duffs ordering stuff, right? We were all working from home. But that really killed their margins. Secondly, they had to negotiate, went through a very difficult negotiation with their union. They had to negotiate comp, which jacked up their costs in the short term. But management, and it's a new management team, laser focused on the bottom line, on improving earnings and jettisoning unprofitable, lower margin contracts in favor of high margin contracts, specifically small to medium-sized businesses. They signed a 5-year labor agreement, which was expensive the first year, but I think it's going to look really smart years 2, 3, 4, and 5, where they have much less volatility in their labor structure with those costs and inflation in their labor structure with those costs locked in. And then the recent development, the reason I'm bringing it up is USPS, the U.S. Postal Service, they just struck a deal with. They're going to be diverting a lot of their volume to UPS, which UPS believes will be accretive both to the top line and the bottom line as soon as the second quarter. This is an immediate shot in the arm for UPS. And management has come out and said it fits, quote unquote, beautifully with their strategy of, quote, leaning into segments of the market that value its integrated network, unquote. So we'll see how it plays out. I mean, the stock is up modestly since that announcement. There's still, I think a lot of skepticism around UPS's targets. Let's put it that way. They had an investor day a few weeks ago where they were very bullish on their bottom and top line targets over the next few years. And I think market was skeptical of those, maybe thinking they're a little too ebullient. But maybe management knew about this U.S. Postal Service deal and was kind of factoring that into their numbers. I'm not sure if that's the case or not. But at this point, there's definitely a risk to the execution story. I think that, it's sort of a prove it story. We really need to see it show up in their numbers, which we haven't seen it so far. But they also have a fairly undemanding valuation at less than 16 times earnings, sort of a trough valuation for them over the last 5 or 6 years. So anyway, I think all three are worth taking a look at, see if they are right for your particular situation. We own for a number of our clients here, and I own personally. Keep that in mind when you are weighing your opinions. Hope that was helpful. As mentioned, we will have a lot more to say on the individual stock front in the coming weeks. My colleague here, Matt Anderson, one of our key people on the planning side, he's a certified financial planner. He'll be hosting next week on some planning topics, which we haven't delivered in a while, and I think around tax time, and I think it's a good time to get a refresher on some of those concepts. I think it'd be well worth you listening, and I'll be back with you soon. In the meantime, as always, I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.